Don Kaufman, and you are watching the TheoTrade evening video, March 17th, 2021. The Fed cometh. I got to tell you, though, the comments out of the Fed, completely and totally ambiguous. I feel left the marketplace in complete peril. S&Ps here just minutes after the cash close are up 10 handles. For the most part, you look at some of the trade action on this session. We were down, we were up, we laughed, we cried. I mean, for the most part, though, you look at the entire trading day, pretty much massively unchanged, but the volatility came down, and I actually think that that's going to be a degree of an opportunity, which I'm going to show you here momentarily. Now, as I was saying, the comments out of the Fed, let's actually start with a little bit of Fed speak. No, there's nothing really to comment on, is in. They're just completely and totally ambiguous statements out of the Fed. They were directly questioned about a twist. They were directly questioned, okay, on all of the fronts that we assumed that they would be questioned. Again, are they actually going to kick off any type of bond buying program? And they basically just said, let's just hold everything in reserve. We're just going to wait and see. And that was the answer predominantly to every specific question regarding the specifics behind, of course, the bond market. And what I'm really referencing is this wicked sell side activity inside of the bond market was questioned again. How did they answer it? As I said, ambiguous by nature. The twist program? Not now. Maybe in the future. Not now. We have huge tools in reserve. And that was pretty much it. But I believe that this actually left the marketplace not only wanting more, but I think it leaves the marketplace. And the marketplace that I'm referencing here is specific. It's the bond marketplace. So please don't read too deeply into that, because if you actually read that statement, you know, oh, this left the market in peril. The bond market, absolutely unequivocally, yes. Sell-side activity could continue to rush into the bond market. The interest rates could absolutely explode. Then, and only then, would the S&Ps be impacted over here. But again, I felt that the statements out of the Fed were completely and totally ambiguous, which is going to leave this marketplace guessing. Now, as I said, I'm also going to kind of get to work on the front of volatility. Before we get there, there's one kind of key thing that I want to go into, and that's specific to the TLT. I talked about this the other evening, and I'm going to reiterate it here. And that has to do with volatility, specifically inside of the bond product. If we take a look at volatility, so we're post-Fed announcement now. And the TLT volatility still at about 21%. Now, that's just for the next 2 days. And again, I am going ultra short term on here just to be able to make a point. So the volatility inside of the TLT now in the next, again, 2 days is actually dropped to about 21%. Take a look at the spiders in the exact same time frame. Look at the spiders in the same time frame, it's actually dropped to 16%. So once again, we still have bond volatility above S&P volatility. And that's why I said, you know, this left the marketplace in a little bit of a lurch here. Okay. And the marketplace, again, I'm referencing happens to be the bond marketplace. Now, with that, so you know that volatility has dropped a little bit. But before I go any further, let's cruise over to the SPX. Okay. We're going to go to the SPX each and every week. On the weekend update, I actually provide detailed specifics of expected move, and that's, well, of course, regarding the SPX. Now, the SPX, where did it start the week? Let's just round. Okay, the SPX, roughly speaking, started the week at 39.40. Now, the expected move for the week was plus or minus approximately $73. Okay, $73. If we had the $73 move, absolutely unequivocally, well, no, not even close. Again, we started here at about 39.40-ish. Where are we right now? Closing price, 39.74. The point that I want to make is you have a lot of room for improvement to the upside, a lot of room for improvement to the downside. So get ready to rumble. Once again, as I've said this time and again, these are expected moves. Now, when you look at an expected move, it's just a standard deviation. This is like a standard deviation just flipped on its side. All right, so you're supposed to come up here or down here, but the key point over here is the probability of actually touching the upper point or the lower point is incredibly high. So you still have to have anticipation, okay? Anticipation, expectation, if you will, that the marketplace, right, on Thursday or Friday, going to cross almost up here to 40.20, okay, and or all the way back down to the 38.70 handle. And you know, in my mind, there's really no in between. And I'm already kind of gearing up for these particular positions. If we actually run, if we rip to the upside and run, this actually could be a phenomenal opportunity to go out and sell some more out of the money call premium. The other aspect, and I'm going to cover this here momentarily, is if the marketplace kind of continues to run to the upside, it's actually going to crush VIX back down. And if it crushes VIX back down, it's actually going to be rather advantageous. So that's why I wanted to cover and kind of start with, well, the bond market. The bond market is ambiguous by nature right now because Jerome Powell gave us absolutely nothing to go on. And I think that leaves, the S&Ps in a little bit of a lurch. Okay. We know that the SPX didn't tag the upper or lower edge of the expected move. So for Thursday or Friday of this week, you have to anticipate, this marketplace it's going to be moving and moving up north of the 4,000 level is something we talked about and discussed literally weeks ago. Is one of the easiest decisions that we made, and that had to deal with when we were down here. When we were down here at the 3780 handle, I literally in one of the nightly videos said this is the easiest decision we're going to make. Whether we're going to explode back to the upside and go right for the 4,000 level, we're going to completely and utterly break down. But either way, as I denoted when we were down here at 3780, I said hold off on your allocation. Hold off on your allocation. Wait for us to explode back higher because now some of the opportunities are starting to roll out, specifically inside of the S&Ps. Again, if we continue to kind of break higher, go with it, especially if you're going to be selling some premium over there. I mean, volatility, as I was saying a moment ago, volatility has kind of collapsed down here inside of, a product like the spiders where it's like down to 16%. But the volatility, when you start looking at like the QQQs, I'm sorry, the volatility in the QQQ is clear up to like 26% still. And again, I'm just looking like 2 days out to make a quick point. And volatility is still rocking in the Nasdaq, right? Volatility is still rocking out in the IWM. Volatility in the IWM, right? 28%. Even volatility inside of the bonds, okay, is rocking. So even though you have a marketplace in the S&Ps, it's all-time high. What is he talking about, a marketplace in peril? Yeah, the S&Ps are at all-time high and volatility is crushed down, but in other products, it's not, okay? And there's really specific reasons for that again, I'll cover a little bit more while on TheoTrade. Has a lot to do with, of course, the XLF versus some of the monsters of tech. But to conserve a little bit of time on this evening's video, let's actually get to work looking a little bit at one of the setups over here. So we talked about the expected move. So we expect this marketplace still have the ability to kind of rock back and forth quite considerably. And if we rock to the upside, okay, take a look at the VIX. All right, it's official. We're at the lowest VIX print. We're at the lowest VIX print. Let's go back over 3 years, okay? Obviously not in 3 years, but we're at the lowest VIX print for a close, basically since the onset of COVID. So right here we'll call February of 2020 the onset of COVID, late February, and that's that huge gap to the upside inside of the VIX. But nevertheless, we're actually at the lowest print. In fact, you start looking at 9 months. This is the lowest closing print in the last 9 months, which you would think would make some of the VIX trades really wonderful by nature. But there is the forward pricing of the VIX. It isn't great. Okay, when I say forward pricing of the VIX, one of the things I want you to look at with me, and I was talking about this the other day, one of the evening videos, but the VIX is actually already pricing its forward future here, okay? And this is 62 days out. So I'm looking 62 days out, and the forward future of the VIX is already pricing it back to like the 25 region. How do I know that? Look at the 25 puts versus the 25 calls. I mean, they're roughly trading for the exact same price. That means, lo and behold, the 25 strike is the at-the-money option. When you're trading VIX, you're not actually trading VIX underlying. Okay, you're not trading the VIX as the underlying. The VIX is not the underlying. The underlying for the VIX options are actually the VIX futures. And I was just looking at, 63-day out, So let's actually go ahead and highlight this for a second. When I say 63 days out, I was just looking, okay, at 63-day options. But lo and behold, look at the May 63-day volatility futures. This is the underlying for the VIX. So if we cruise back over to the VIX, okay, the big story is, yes, the VIX has actually contracted quite considerably. But 62 days from now, it's already pricing reversion back up. So it's already pricing like, hey, we're going back up and we're going to be already back up at 25. So I am doing a little bit of an outlier type trade. And when I say an outlier type trade, the skew inside of the VIX is just downright monstrosity. So let me close up this left side bar and really display this to you, because again, this is the stuff that's like advantageous right now. Take a look at the implied volatility. Now, this is an option that I happen to be buying, and this is an option that in fact I'm selling. Okay, so there's a buy side of the option, a sell side of the option, so it's a spread. All right, and forget about selling anything against it. Down here is my buy, over here is my sell. Why am I actually doing that? I'm buying an option close to about 114 implied volatility, and I'm selling an option for almost 150% implied volatility. And in effect, all I'm actually doing over here, I'm getting a cheap shot. Okay. Now you may look at this as like, why is he doing this trade? Okay. I'm actually buying a 35.65 call spread. This is a $30 wide call spread. I'm buying a $30 wide call spread for $1.40. $1.40. What's the most I can lose? I can lose $1.40. Am I selling anything to finance this? No, don't even worry about that. Not even going to sell anything to finance this. Okay. I'm just going to buy this spread for $1.40. Why? Because the spread could make as much as $30. It's not going to make $30. I'm going to tell you that right now. I've been in these types of VIX spreads. I've seen the marketplace crash when I'm in these VIX spreads. You're probably going to make maybe half, maybe 2/3 in a very severe crash. Meaning, if this is a $30 wide spread, the most you're probably going to be able to make probably about $20. But $20, you only have $1.40 at risk. So there's two things you can use this trade for. Number one, you can use it as what we call an outlier. Okay, what's an outlier? An outlier simply means if the S&Ps crash, the VIX explodes. If the VIX explodes, that trade is going to pay off. And you literally have 63 days, and if nothing happens in the next 63 days, okay, you lose $140. Okay, if something happens in the next 63 days, okay, it could be spectacular. The other reason, and this is the real reason I use this, I'm actually buying this VIX call spread as a hedge because I have every intention of selling out of the money puts inside of the S&Ps. Okay, why am I going to sell out of the money puts inside of the S&Ps? I know. Because the skew is massive. Okay, skew is ridiculously high. When I say skew is ridiculously high, like I don't want to confuse anybody, right? When I say skew is ridiculously high, what I'm actually referencing is the out of the money puts. The out of the money puts inside of the S&Ps, okay, are trading. The out of the money puts inside of the S&Ps. I'm going to go look over at the spiders. And you know what? Whatever. I'll just open up like 30-day options in here. Okay. Look at the implied volatility. Look at the implied volatility. Look at it in all of its glory. Okay. The implied volatility is completely jacked up at the puts. Okay. And it's fairly minimal inside of the calls. So I can't tell you exactly what I'm going to sell puts, but you better believe I'm going to sell puts because the skew is completely jacked up. And by buying the call spreads in the VIX, okay, I am protecting myself to a degree if we do decide to crash and burn to the downside. So what am I doing? I'm buying a cheap VIX hedge. Okay, buy it while you can. Buy a cheap VIX hedge right now to, in fact, all right, in the next couple of days, couple of weeks, I'm actually going to sell some out of the money puts. And you don't have to sell out of the money puts necessarily in the spiders. You could do it in the S&P options on futures. You could do it in the micro options on futures. You could do it in the SPX. But you got to know when to buy your hedges, okay, and when to actually sell that premium. So again, the Fed left us with absolutely nothing, except the Fed leaving us with nothing. It still crushed down volatility, and I think opened up some great opportunity. People, next couple of days, watch for some volatility inside of the S&Ps, okay, but more appropriately, watch the bond product. The bond product doesn't know exactly, okay, what's coming right now. You can feel it inside of the volatility of the bond product, and that unto itself could be extraordinarily dangerous both for financials and technology. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.